Thank you all for coming. Christoph is not as nervous as me, so I decided to bring something. You know how kids have dolls they take to bed, etc. So I brought something so I wouldn't be so nervous. Come on. So I was thinking of wearing this today. A lot of you know Gary Busey. He's kind of out there, and being a contrarian, some people consider me to be somewhat out there too, so. So first thing I'd like to do is thank the people who put together the show. It's a tremendous amount of work, so I'd like to thank Jay Martin and Danielle. They're two of the key people. Jay's up top. And I'd like to take a moment to thank Joe, Jay's father, who started this whole thing, and a tremendous amount of work, and I think they put on a great show. So today I'm going to talk about how to invest wisely in fascinating times. Can everybody hear me well enough? Okay. So one of my favorite words in the English language is continuum. So a continuum, as I'm sure you likely know, is something stretching from one end to another. And I think part of the reason I like the word continuum is there's not that many words that have two U's in a row in them. There's vacuum and continuum. So it always kind of fascinated me, that word, for whatever good, bad, and different it is. So I look towards the United States. And we know it's a fascinating time. And if you want to put together a continuum, on the one end you have Barack Obama, used to be the president, as you know, and now you have Donald Trump. Could two people be any more different? I'm not going to get into politics here. I know who I prefer. But another continuum is risk and reward. So again, these two lines, some overlap, some move in between. And my feeling is that under Barack Obama, there was far less risk than there is today. Because he wasn't tweeting at 3 o'clock in the morning, whatever came into his head, perhaps after a few drinks or whatever. Whereas with Donald Trump, in many ways, you don't know exactly what you're going to get. And he basically says or tweets what he thinks. And that's creating a lot of question marks out there. So when things are fairly volatile, there's two places that people often go when they fly to safety. What are those two places that people often go to fly to safety? Gold. So gold is one. You're at a conference here with commodities and gold. And I think that gold as something that's safe doesn't really make sense to me. Some of you may remember years ago when gold was at $850 an ounce. Then it fell to about $250 an ounce. So let me just ask you, how safe is that? Not so long ago, gold was at $1,800 an ounce. Now it's at about $1,200, and it went down further than that. Again, how safe is that? So I question gold as being something for safety. I do think it is something that's good for diversification, but that's a completely different thing. So I like gold. I think gold can be worthwhile to own, but in terms of safety, not so good, unless maybe you're fleeing a country and you've got some things that you can get through a border with. What's the other thing that people look to for safety? US dollar. So the US dollar people go to for safety. I don't know how many of you have looked at the US balance sheet lately. They've had a debt, a huge, huge debt. You can go online and look at the debt clock, and they have a deficit, and it keeps on increasing. So they're going very much in the wrong direction while their economy is going in the right direction. In terms of a place that's safe, in terms of putting your money there, I highly question that too. So then you have to think, where do you go for safety? Now, often when I talk in Vancouver, I last talked in January, I focus on our methodology at Contra the Herd. So we're contrarians. We invest only in companies been around for at least 10 years, generally making money, turnaround situations, that kind of thing. And after, you're welcome to come to our booth and talk to us. We're over at number 5. But today I'm focusing more on investing wisely during turbulent times. So why are the times turbulent? It goes beyond Donald Trump. You take a look at the debt levels, not only in the US, but in this great country of ours. Provincial governments, the federal government, municipal governments, almost all have huge debt loads, and they're increasing. This is very dangerous. Somebody want to tell me about shorting the Canadian dollar and where that is at right now? You know what shorting is, or think it's going to go down? People talk about shorting stocks. The shorts on the Canadian dollar, anybody have any idea where they are now? The shorts on the Canadian dollar are at a record level. More people are betting that the Canadian dollar will go down than ever before in terms of total value. Doesn't mean they're going to be right. But a number of years ago, when the Canadian dollar was higher and at parity with the US dollar, we invest both in Canada, the States. Some of our investments in the States are ADRs, so maybe France or Israel or other places. I was betting a lot on the States because I thought I'm less afraid of the States and the US dollar than the Canadian dollar. So I built up the portfolio so it was well over 70% in the United States as compared to Canada, which has actually led to a huge return for us just in the appreciation of the American dollar. Now, while there's a huge bet against the Canadian dollar, I'm questioning it. I'm not saying it's not going to go down further, but it's already down at about 73, 74 cents. Some people think it'll go down to 65 or lower. And it may. I don't really know. But I think longer term, the Canadian dollar is usually a fair bit higher than it is now. So ultimately, I think it's going to get there. So what are some other danger factors that are right now? If you look at stock markets around the world, many of them are at record levels. To me, that's major danger sign. You look at the S&P, the Dow, some European markets, etc., they are at super high levels. So going way back to prior to the tech wreck in 2000, fall 1999 in our quarterly issue in October, we compared Moore Corporation, huge envelope company, with Commerce One, which had a much higher valuation than Moore, but Moore had tremendous revenues, losing a bit of money. Commerce One had 0 revenues. So in the tech bubble, I remember being up in Northern Ontario the day it went up 500 points and hit 5,000. I said, this makes no sense to me. It was fascinating to watch on CNBC, but it made no sense. So we basically thought this won't last. I remember being on This Morning, which was Canada's #1 radio show, with a woman who was very bright, and she was saying, like many people, we're in a new paradigm. Technology was a new paradigm. I said, no, we're not in a new paradigm. It's same old, same old. This is another bubble. And the thing that doesn't change is people and human psychology in terms of fear and greed. So when markets go way down, as they did in 2000 and 2008, what do people generally do? They run from the stock market. And that's when they should be looking to invest after there's a blow-off. Greed, when markets are going really well, what do people do? They want to keep up with the Joneses. They invest. It's like the worst time to do it. So when I was on This Morning, CBC This Morning years ago, it turned out that I was correct. It wasn't a new paradigm, a huge blowout. And it's taken years for the NASDAQ, 17 years, to climb back to where it was. So there's major problems for you. Trump, as I mentioned, major problem. Now we're seeing disagreements, G7 meeting. People are looking at things, the other countries, in somewhat different ways. We've got Brexit going on. Now, I don't even know still if Brexit's actually going to happen. A lot of people look at it like a fait accompli, and I don't think it's actually as major as a lot of people think. But it's when you have major changes like that, can create problems. Things that people aren't talking about now are something like Greece. Greece is still having huge problems. And many of the European countries have huge problems. Italy, etc., Spain, etc. So what you're seeing is the media, and as many of you know, I write for the Globe and Mail. We have the Contra Guys column every 2 weeks. I know many of you have seen me on BNN. I'm on Market Call about every 5 weeks. But the media only has so much space to write about things or to follow things. So for quite a while, Greece was the rage. It isn't right now. So you have to think a lot of these things have not gone away. They've actually gotten worse. So 2008, we know we had major blowouts, Lehman Brothers, et cetera, et cetera. If you have not seen the movie The Big Short, it's a wonderful movie. Read the book. If you're investing and you want to know more, make sure you do a lot of reading. It's absolutely critical, whether it's business books or whether it's the Globe and Mail, other media. I was just in Hungary for 2 weeks. The Financial Times is there all the time. You can get it here, of course. But there's so many problems out there that I actually perceive there's greater risks than in 2008. So after 2008, a lot of people said, don't invest, don't invest, don't invest. I never seen anything like that. People often say to me, you've been investing for about 40 years. I know it's hard to believe, but I've been investing for about 40 years. You must have seen it all. And I said, well, I hadn't seen 2008 before. It was a whole other level. Even I was afraid to jump in and invest, but I did do some investments. As a lot of you know, mostly U.S. bank financials, which is still over 33% of the portfolio, even though we've sold a lot. So markets are really, really high. In terms of investing wisely, here is what I'm doing now. I like to think it's wise. I'm investing less now. So over the past year, I've only bought 2 stocks for the portfolio. Even then, I'm not an active investor. In a normal year, I buy 3 to 5. Active investing, as most of you probably know, does not generate as good returns as more passive investing. I don't believe in buy and hold, although we tend to hold a much longer time than most people. But we're always looking at 100% plus gains where stocks have been before. But I think it's important right now, don't get sucked into the bandwagon of buying into things. What I also want to do is I want to sell a few more things. So whenever we buy anything, we set an initial sell target. So we're very, very disciplined. In one of the books I have, Christoph, can you hold up that one? No, the other one, the white one. The white one. In that book, there's one page, and all it says is, without discipline, you have no method. That's the whole page, and that's critical. And too many people, they blow in the breezes, and now people are more likely to blow in the breezes than ever before. Some of you have heard me talk before, have heard me say this, because 25 years ago, not many people were on cell phones. People weren't on the computers all the time. They didn't have the internet to use. I figure it came about 1994, I was on it. That was more of the genesis for most people. So all of a sudden, people are getting information constantly, which means they're going to react more and more. So if you want to invest wisely, I suggest that often less is more. If I'm not really quite positive about something, I can still be wrong, but I won't do anything. So when Donald Trump came into office, I had no stocks near my sell target of the 23 in the portfolio at that time. Now there's 3 near the sell target, and I would like to spin them out when they hit it, or maybe possibly go a little above in terms of market timing. but I'm looking to sell more so that if I lose money, if markets have a blow off, I'm not looking to get out of the market, but I will lose money on less money invested into the market. So where does the money go? A lot of the money goes into really boring stuff, earning 1.5%, 2% cash on the sidelines. Nothing sexy about it. It's taxed at a high rate, unfortunately, but I'm willing to deal with that with some of the portfolio to try and have money on the, well, I always have money on the sidelines, but to get it off the table in terms of risk and then to invest it later on. So I'm going to turn it back over to Christoph because he's got something to say.
We are now going to be, you guys can ask questions and we'll answer them.
Oh, the two stocks that I bought, it's a great question. One is GMP Capital. So they basically are wealth advisors, and then they also do IPOs, that kind of thing. Right now, I think they're doing a lot in the marijuana industry because banks can't do it. In the past few years, about 35 companies in this field have folded because a lot of people do not want other people managing their money and taking somewhat higher fees. And that makes sense. I think most people can manage their own money and do better than giving it to a financial advisor if they're willing to read. But I still like GMP. It's gone up a bit since we bought it. I paid $3.32 average, around $3.50. Just an additional note, last fall TD was looking to buy them. It got turned down. Often if somebody is looking to buy you, you may get bought out at a higher price. The other company is called Wylan. They basically buy all these patents and then they do lawsuits to protect the patents. I do not like their business model at all because it's litigious. Unfortunately, what they've done in the past month or so is they bought two other companies at very, very high prices. When I look at it, they had over $100 million in the bank. They paid a dividend, no debt. Now they've used up most of that money on the two acquisitions. It's certainly not as good a buy as it was when I bought it. I did not think they would make the acquisitions that they did. So, what's that? 2 minutes. Okay, I'll take one more question, if we have it, and then it goes back to Christoph. Yes? Okay, so other than interest-bearing instruments, where else might you put money? I wouldn't race into real estate. Real estate's really high here. It's really high in Toronto. I think there could be a prick of the bubble in real estate. Some people say you can't recognize bubbles before they crash, but we did it certainly in 1999 before the tech bubble. We were a bit early on 2008, but it didn't make much sense. You know, sometimes it's worthwhile if you have a hobby investing in things that are your hobby that may have a certain amount of value. So if you like art, put it up on the wall and enjoy it. Don't even think of it maybe as an investment, but maybe you can buy it, stamps, other things. Baseball cards, hockey cards, but again, look at relative markets. It's a lot harder now to find other areas to invest in. One thing I would think about in terms of is, and you're not going to get a return monetarily, but traveling. Traveling is a fabulous way to use your money and get a return. And after 9/11, it was one of the best times, horrible time, but a great time to travel. So look at some countries where they're having some difficulties, where the economies aren't going well and the currencies have gone down, and you can travel there at a discount. So to me, those kind of things make sense. But being a contrarian, a little different. And once again, for the last time, I'm turning it over to Christoph for some final words.
Okay, so we are selling books here at booth number 5 and down there, and I hope you guys buy some because I get 25% for each book, and I hope that helps me for university, so buy a book.
Thank you all for coming. As Christoph said, we're at book number 5, and those are all best-selling books that I wrote about our stocks and starting a business. Thanks for coming.